In this week's video, we'll review the latest charts to help us answer the question, was this week's rally the last hurrah for stocks before a sharp global sell-off? Is global weakness foreshadowing a global stock meltdown? Unquestionably, there are concerning things on this chart of the global Dow. We have a high here and a major RSI divergence earlier in 2018. We're in our consolidation box. We get a bearish breakdown here, and RSI goes to oversold levels or below 30 for the first time in quite some time. It's possible some of you have already noticed that the chart that we were looking at on the left-hand side was not calendar year 2018, but rather calendar year 2004. This chart is dated May 19th, 2004. And you see we have some similarities between this period here and the present day. Huge overbought signal in RSI here. Massive overbought signal in RSI here. These are very rare signals. Really don't have anything like this or this between these 2 points. In this case, we have consolidation. In this case, we have consolidation, and we have a bearish breakdown here. And like this period here, we get somewhat of a double bottom look in RSI. It goes below 30, somewhat of a W look in RSI, then it pops back above. Price comes down, makes a lower low. Price comes down here, makes a lower low, and then pops back up. It's very, very difficult to look at this chart and or this chart and make an argument that they don't look concerning. They do look concerning. There's nothing particularly bullish about a breakdown like this. And there's nothing particularly bullish about a divergence like this. So a fair question is, what happened next in the global Dow in 2004 from this point A in May of 2004? If we fast forward, we can see really good things happen for a long period of time. And the gain from the concerning look that's very, very similar to some of the concerns that we have on the 2018 chart was a whopping 149% over several years, simply telling us to keep an open mind about all outcomes in the present day, including better than expected outcomes. Now, we know from past videos that all good things must come to an end. And if you have good eyes, you can see a dotted line here. This dotted line was actually placed in the chart by stockcharts.com. And somewhat ironically, this chart is dated Halloween 2007, October 31st, 2007. This area up here represents major resistance. Remember, I said stockcharts.com put that level in there. It also drew this line here. This point of major resistance here is the exact same level that we are testing again on October 31st, 2018, which tells us unequivocally and without a shadow of a doubt, the global Dow index has gone absolutely, positively nowhere for 11 years point to point. And here is that same dotted line drawn by stock charts. We've just made it a little bolder in this version. What once was major resistance may now act as major support. Notice that expression uses the word may. As we always say, we will learn something either way. This chart is dated November 1st, 2018. This level here is 2877. We went below it this week and now are back above it at 2925. This is an active and ongoing retest. The outcome is to be determined. And this is our point-to-point where the market has gone absolutely nowhere for 11 years, which makes it very, very difficult to make the argument that global stocks up here are in a bubble. Market fractals tell us that this is a form of consolidation. How do we know that? Because we can draw numerous horizontal lines spanning numerous years, and we hit price multiple times. This is somewhat of a pistol formation, a bullish breakout, and right now this looks like a retest attempt. As we know, retests can pass or retests can fail. So this was the mother of all breakouts. This is either going to be the mother of all retests or the mother of all failed breakouts. We will learn something either way. And in either scenario, we can envision getting a big move in this direction or a big move in this direction. Everything we just said about the global Dow conceptually applies to the value line geometric index, which is an excellent way to track the average stock. The average stock came up and hit resistance and price was rejected in 1997. We are basically back in the exact same place in 2018, or 21 years later. What once was resistance in 1997, what once was resistance in 2007, what once was resistance in 2015, may now act as support during a retest in calendar year 2018. Like the previous chart, we will learn something either way. It's pretty easy to envision a big move in this direction or a big move in this direction. Right now, as this chart sits on November 1st, this is a retest in process. We still have a bullish breakout. As always, we'll take it day by day, and we'll learn something from this chart and many others that we're going to cover in this week's video. If we're going to go into a multiple month or multiple year bear market, these simple concepts are going to have to change. This is the NASDAQ Daily, calendar year 2018. Thus far, the NASDAQ has made a discernible higher low relative to the February 2018 low. And the last major thing was a new all-time high that was discernibly higher than the January 2018 high. Obviously, this is subject to change, but it hasn't changed yet. And we could go through the exact same exercise for the S&P 500. Fractals tell us that concepts apply to all market time frames. You can make an argument the current rally began in February of 2016. We rallied into the recent peak in 2018, and so far, relative to this trend here, this looks like a normal retracement within the context of an existing and ongoing trend until proven otherwise. We remain well above the 38.2, 50, and 61.8% retracements. Obviously, that's subject to change, but it hasn't changed yet. The same concepts apply if we assume the current trend began in November of 2016 near the U.S. presidential election. In that case, based on this A to B move, we are also above all three fibs, and you can make an argument we tested the 38.2. It's the Dow annual. We've covered this before. These are long-term trends that are still in place. They are vulnerable, but they are still in place. Bullish cross, bullish cross, bullish here. This looks similar to this and this. After we could see this, good things happen for a long period of time. After we could see this, good things happen for a long period of time, which is quite a bit different than after we could see this consolidation and frustration happened for a long period of time. Quite a bit different. This doesn't look anything like what we can see here when the dot-com peak occurs in the calendar year 2000. This doesn't look anything like this. And after we could see this, the results were very, very similar to this. Sideways consolidation for a very long period of time and a very, very frustrating period for investors. A very, very frustrating period for investors. Harder markets are typically followed by easier markets. Harder markets are typically followed by easier markets. On November 1st, 2018, the Dow is still up year to date, and we have not lost this signal. How long it remains in force falls into that to be determined category. NYSE Composite, what could turn out to be a major low in February of 2016. We have a peak in 2018. So far, we came down, and it looks like we have tested the 38.2% retracement based on this A to B move. In its present form, relative to this ongoing and existing trend, this looks like a normal retracement within the context of an existing and ongoing trend until proven otherwise. We had what looked to be a bearish breakdown from this consolidation box. As of November 1st, we're back in the box. We'll learn something either way, if price moves in this direction or if it moves in this direction. Just as a reminder, to keep an open mind about what this breakdown looks like. Remember last week, we showed a very, very similar and concerning breakdown in emerging markets that occurred in 2016. And instead of getting a devastating move in this direction, we got a big move in this direction, telling us to keep an open mind about all outcomes in November of 2018. Not really a huge fan of trend lines because they can be very arbitrary in terms of the way you draw them. But if you connect here, what once was support, actually acted as resistance the first time on this bounce, and then we recaptured it. So this looks like a bearish breakdown. And now it looks more like a retest of this trend line here. We classify this as anecdotal evidence. We don't use anything like this in the model. This would also be somewhat anecdotal evidence. We covered this chart, I'm guessing, sometime in 2017. So these lines were drawn a long, long time ago to show this. Resistance at the green line. Resistance at the green line, a bullish breakout, and what now looks like a retest of the same line. What once acted as resistance, may now act as support. And so far this week, we're trying to bounce. On November 1st, the weekly chart was up 3.17% with Friday still to go. Like all the other charts, we will learn something either way. Move in this direction or a bounce. These are generic and for illustrative purposes only breadth charts using generic moving averages. This line here is NYSE up-down volume. So you take all of the volume associated with rising issues and subtract all of the volume associated with declining issues. If you know your market history, this is a breadth indicator. This is really where the S&P 500 gets ugly in the dot-com bust. It's really early September of 2000. And if you know your market history or traded these markets, you probably remember there was a sharp counter-trend rally in the S&P 500 from the Q1 lows in 2008. So basically, we came all the way back up in the spring of 2008 to the lower end of the consolidation from 2007. Moral of the story, this is where it really got ugly in the stock market And this is where it really got ugly, on the right side, on the right side. Some quick takeaways. It got really ugly here, and our breadth indicator was on its second discernible and measurable lower high. It got really ugly right here, and in this case, our breadth indicator had basically been moving sideways literally for years. Similar situation here. Our breadth indicator is consolidating, has somewhat of a rollover look. We can draw horizontal lines and hit the indicator literally going back years. Look how close the indicator is to the 50-month moving average. Look how close the indicator is to the 50-month moving average. We're rapidly coming back to it, rapidly moving toward it. And look at the slope here. It's rolling over, indecisive, flat, rolling over, indecisive, flat. How does the exact same chart look today? The answer is much, much better. Instead of moving sideways for literally years, moving sideways for a long period of time, this indicator printed a new all-time high recently. This is November 1st, 2018. If anything right now, the indicator is moving away from the 50-month rather than rapidly toward it, The white space that we have here is greater than the white space that we have here. This doesn't have an imminent rollover look to it. Moral of the story, this really doesn't look anything like this, and this really doesn't look anything like this. Like everything else, it just speaks to probabilities, and probabilities are far from certainties. We've covered this for several weeks now, so we will move quickly. November 1st, 2018. Simple, generic, and for illustrative purposes only, 100 in orange, 200 in pink, and the 300-day simple moving average in green. Similar concepts to what we just covered. 9 months of sideways movement point to point here. And as we just said, things really started to get ugly for the stock market in here. And things really started to get ugly for the stock market in here. 5 months of sideways movement, and at the really ugly stage, 17 months of sideways movement. The same moving averages recently printed a new all-time high. We don't have any bearish moving average crossovers, bearish moving average crossovers, bearish moving average crossovers, bearish moving average crossovers. This is a waning rollover. This is our barge rolling over. This looks like a relatively strong and sustainable trend in its present form. We know that it is possible that this is going to morph into something like this. But it hasn't happened yet. If I draw lines backwards here, I hit nothing. Draw a line here, I hit nothing. Contrast that with drawing a line here and hitting the same line 9 months prior or 17 months prior. Just a different way to look at our trends, consolidation. Bullish moving average crossover, generic and for illustrative purposes only, 8 and 9 year moving averages, blue above red, good things happen. Blue above red, good things happen for a long period of time. Indecisiveness, flat MAs, indecisiveness, flat kissing MAs. This looks a lot more like this or this, and really doesn't look anything like this or this as of November 1st, 2018. As long as this chart looks like this, it's telling us the long-term trends are almost acting like a magnet, pulling up our shorter-term trends to get back in line with the longer-term trends. And obviously that is subject to change. It changes here and it changes here. We just don't have an imminent change look. If anything, we have the early stages of a new long-term secular trend look. Like every chart we cover, if the facts in front of us change, then we will have to change our assessment of the probabilities. Same exact concepts as of November 1st, just a little bit different way to look at it. This is not a particularly concerning look in the present day. All of the basic concepts that we covered on these charts apply to this chart. This is monthly stocks versus bonds. This is the 50 generic and for illustrative purposes only monthly moving average. Stocks versus bonds. WHOSX is a proxy for TLT. They are very highly correlated. Sideways movement. Several months here. This is an indecisive look. This is the beginning of October. This is where the stock market peaks in here. You can see a discernible lower high relative to this high. And our ratio is moving rapidly towards a flattening 50-month moving average. Remember we said really bad things happened in the stock market out here? Here's your counter trend rally because this is the stock market outperforming bonds. Look what happens here. This is a wonderful place to add defensive positions. Why? Your trend is rolling over. Your long-term data still looks shaky here. And you go up here and basically fail, telling us that this trend is still in force. Unfortunately, humans, most of us, add our defensive positions in here right before this major counter trend rally. How does the exact same chart look today? Infinitely better. The ratio is nowhere near an upward sloping 50-month moving average. We recently broke out of, in a bullish manner, a period of consolidation. So here's your sideways movement, This is a bearish breakdown. This is a bullish breakout. Notice with the breakdown, we get the rollover of the moving average coinciding for the most part with the breakdown. We get a turn up. The slope increases here, coinciding with the breakout. In many respects, this is the polar opposite or the mirror image of this. This chart is dated November 1st, 2018. And as we often state in these videos, we are not using these charts to forecast. We are making probabilistic statements based on the facts in front of us. If the facts in the present day morph into something like this, then we have to be flexible enough to adjust our assessment of the probabilities. Do we still have things to be concerned about in the present day? Absolutely, positively, yes. This is the 200-day moving average for stocks versus bonds. This is our inflection point look. Bullish, bearish, trying to turn back up, bullish. This is telling us to pay attention and to keep an open mind about all outcomes. Same thing here with SPY. We have a rollover look. This is a bearish look here in the very short term, but now it's flattening out and looks more like an indecisive look similar to this period here. The further we can move away from the recent low in stocks, the better these charts will look and the inflection will move in this direction. Conversely, if the S&P 500 goes on to make a lower low, the math is telling us this is going to roll over and this is going to roll over. Maximum flexibility, day by day. Trade the chart in front of us, not the chart in the rearview mirror. It's a chart we've covered in past videos, stocks versus bonds. In this case, we are using TLT. It's a weekly chart. The generic and for illustrative purposes, only 22-week moving average here. It's difficult to say that this point here, followed by a rally in stocks, and this point here, followed by a rally in stocks, is discernibly different from this point here. We come below the moving average and go back above. Below the moving average, come back above. Below the moving average, come back above. We can also make an argument that this is a bullish breakout here from a consolidation period. This is a retest, and we know retests take many forms, including looking like a failed breakout and looking like a breakdown only to reverse. I would say this is a retest still in progress, but right now it's leaning towards a bullish resolution. Why? Well, on November 1st, the ratio is up 4% for the week, and we have an upward sloping 22-week moving average that we have recaptured. If we move back into the box and this rolls over, our concerns would increase. Remember, we said really bad things happened in the S&P 500 here in the spring. Here's your counter trend rally. Look at the 200 and the 50 here and compare and contrast it to the present day. This is the S&P 500. This is the NASDAQ. This is the point here in the dot-com bust. Here's September. Really bad things happen after this. Compare and contrast this high-risk period here and this high-risk period in here with the present day. This is concerning. This is concerning, and this is telling us to pay attention. But this is a much, much stronger trend than this period here, and this is a much, much stronger trend than this period in here. Our concerns would increase if this morphs into something like this area here or this area in here, which absolutely positively may happen, but it hasn't happened yet. Let's talk a little bit about some of the factors and considerations that go into risk management when we have waterfall type declines. These are the look of the daily candles for the S&P 500 as of the close on Monday, October 29th. I can assure you, prior to the close, this candle here looked a lot more like this candle here. We've got a short takes post about this, so I won't go into too much detail about the candles. But when we're here, and especially when this candle here looks more like this candle here, with unabated selling pressure, and that's the look of this candle here, possibly 20 minutes before the close, it looks more like this candle. And in terms of present-day context, we could make an entire video covering the rare stats that have occurred over the past 4 weeks or so. Here are some examples. Ryan Dietrich. How persistent has the selling been lately? Today will mark the 28th consecutive day the S&P 500 doesn't have back-to-back up days, tying the longest streak since the Great Depression. When you're managing risk, you really don't want to be seeing analogies with the Great Depression and with 1987. In Monday's session, in a 1-hour period, there were 5 100-point swings in the Dow Jones Industrial Average. So when we're here, with the math that we have in hand, and in the last hour of trading, when this candle really looks more like this candle, in our situation, we of course have a good handle on the data in the model. The trend strength portion of the model has 2 components, a shorter term component and a longer term component. Both of them had dropped below 50 here, basically telling us what happened from here, for the most part, is a coin flip from a probability perspective. We could move sharply in this direction, or given the relentless selling that we had seen in the month of October and all of the "this has never happened before" stats, or "this hasn't happened since," it's helpful to understand just how devastating the 1987 crash was. This is a closing level on Friday, October 16th, 1987. This is the massive gap down that happened on Black Monday. So when you're managing risk, when you're here, you somewhat have a binary decision to make. We're either going to manage risk and allocate to the data that we have in hand here, or we're going to wait for the market to open up on Monday and hope that everything works out. When the market opened up on Monday, there was no time to make any changes. It opened up over 20% below this level here. We did get a decent rally intraday, and then we came all the way back down and basically closed where we opened. So to put that into some context, when you sit in our chair, if a client had $1 million here, when the market opened on Monday, they would have been down over $200,000. And when the market closed on Monday, they would have seen a loss of over $200,000. Once this gap down occurs, there's absolutely nothing you can do. There's no way to go back in time to the previous Friday and manage risk. And the market action that we were seeing, the market really wasn't reacting to any setups. There was really nothing to speak of in the way of protracted counter-trend rallies. And we basically just had an incredible amount of unknowns in here. So when you're sitting here, one possible outcome is something like this: a massive gap down, putting yourself in a position where it's going to be very, very difficult and nearly impossible to recover these losses in the short term. Let's contrast that with allocating to the data here or allocating to the data here. If you're wrong in this case, you're wrong in a big way. If you're wrong in this case, and this is the 2016 low, we can recover from this. We can take cash and redeploy it. But once we lose that cash, when we're down here, there's no cash to redeploy. A drop like this could do an incredible amount of fiscal and psychological damage to human beings, including our clients. And as we wrote in a short takes post, if we have some cash down here and we're not fully invested at this point A here, given the magnitude of the moves that can follow sharp corrections, it's not the end of the world if we miss out on a 1 to 2 to 3% return in here, possibly, relative to being down here, possibly, where it's basically impossible to recover in the short run. If you're a relatively new client, you might want to find this tweet in our Twitter feed, but it basically says a lot of the sales or the profits that we took this week, because it was profit taking. Many of the positions we entered in here in May of 2017. Here's our entry point. Here's our exit here. This is a profitable move. If you're a newer client, your entry point, if you weren't a CCM client here, it's impossible to have an entry point here. Over time, this will correct itself. How? We all have cash now. So even the newer clients, when we redeploy that cash, will get the identical cost basis to the rest of us. We have a short takes post about this chart here. So let's just hit on some high points. The further price can move away from this low here, which is down around 2610-ish on the S&P 500. So the further we get in this direction, or the more it looks like a bottoming process, the more prudent it becomes to allocate back as soon as possible to the longer term trends. If price decides to move up and down within this range, how we handle that will be data dependent. We'll be looking at things like market breadth and volume to try to get an idea. Are we seeing a conviction shift? This is high selling conviction. We need a transition to higher buying conviction. And below this week's low here, then we basically have to forget the longer term trends respect the bearish inflection point, focus on principal preservation, and if this morphs into a bear market, we have to think about migrating to defensive positions. The type of inflection point data that we have today aligns with these tweets. The markets and the data are oscillating between this looks like the early stages of a new bear market and this looks like the latter stages of a correction within the context of an ongoing bull market. Obviously, our allocation for case A would need to be radically different from case B, and that's where maximum flexibility comes in taking that longer term focus. And that applies to a bullish transition and a bearish transition, and you can see that in the short takes post. Here are some historical examples. We have inflection point type charts in data in September of 2000, December of 2007, October of 2011, and February of 2016. So the setups look very, very similar. The outcomes are radically different. The first two morph into devastating 50% plus declines. In October of 2011 and February of 2016 were fantastic entry points from a risk-reward perspective. Last week's video, we looked at this long-term annual chart of the S&P 500 that we covered back in July of 2018. This is a constructive look here that we've covered numerous times in the past. This looks a lot like this period here. This point A is similar to this point A. After this, good things happen for a very long period of time. Look at the magnitude of these gains and think about the magnitude of the drawdown that we've had. The magnitude of the drawdown in the present day is painful. But if we can get aligned properly with the next trend, whether it's up or down, the magnitude of the drawdown that we've experienced in October of 2018 could pale in comparison to that next move, whether it's bullish or bearish. As of last week's video, the S&P 500 was down year to date. That's also somewhat of an inflection point look. If we fast forward to Thursday evening, November 1st, we're back up 2.5% year to date, which is very, very similar to where we were in July of this year, up 2%. At this stage here, this chart still looked very, very constructive, and in the present day, it still looks constructive. These are powerful shifts here. These are powerful shifts here. Remember last week we said we had to ignore these time frames. The more improvement that we see on the shorter time frames, and the further we move away from the recent low, the more important all of the longer term evidence becomes. To the contrary, the weaker the shorter term charts get, and if we take out this week's low, the less relevant these time frames are from a risk management perspective. So as we've covered in numerous forums, our goal is to get aligned with the next big move. And to do that, we may have to increase our trading frequency. If you're a client, you can see we've already done that. We may have to experience some whipsaws. We've experienced some whipsaws. And we're going to have to deal with some emotional swings. I think it's pretty easy for anyone that has been associated with the markets in the past 3 to 4 weeks to check this box as well. And when we have waterfall, extremely rare, have never seen before type charts, we have to respect the psychology that we covered in last week's video that says the next hypothetical bear market could see a 66% loss in a much, much shorter period than these bear markets. If you're a client and understandably, you might have some questions. A lot of strategy type questions can be answered by simply scrolling through our Twitter feed. You don't have to be on Twitter or particularly like Twitter to access this page. It's just a regular web page. You can find it by Googling Shavako Twitter. And to try to keep the video a little shorter, you can reference this short takes post dated October 31st, another one dated October 30th, a second one with some good statistics on October 30th, and a little more detail on the ugly high-risk look, plunge-type look that we had on October 29th. It may also be worth a visit to the new website to see the FAQs. We've got new and expanded FAQs covering traditional investing, low-cost passive investing, and the online/robo strategies that are currently in vogue. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.